Hey folks, and welcome to the Pipnotic Symposium for the, 4th of June 2019. Danny asked about a symposium about short-term trading, and so we're going to have a look at that today. Okay, so short-term trading is nice because you're seeing some results pretty quickly, and you're not exposing yourself to overnight risk, which of course is quite nice, especially these days when there's so much market volatility going on with the trade wars. So if you're trading the American dollar, then you're exposed to some pretty significant volatility because of this trade war. And so what you need to do is you need to focus on, you have to be aware of what's happening in the news when you're looking at these smaller time frames. But that said, you should be more focused on the major flows, because this is essentially going to dictate what direction a symbol is moving. And so even if you're trading on the really small time frames, you should be mindful of what's happening on the bigger time frames. And this is because you simply need to know where the major money is moving. And if we have a look at the euro US dollar, if you look on the daily chart, which is going to be our long-term time frame, you can see that price is racing higher. But also notice that we're approaching this area of daily supply. That means that it might be a little bit late to start to buy. I'm not saying you can't buy, but we're approaching the beginning of the sell zone here, which are the highs of this area of this continuation pattern and these two highs here. So you just have to be a little bit careful. If you're looking at the 50-minute chart, it's buy, buy, buy all day long. And so you just have to be very careful about not paying attention to these major flows. Okay, and so you can totally trade in the small times, but you have to know what's going on these major flows. So what I like to do is I like to wait for price to enter an area of supply or demand and then go to the smaller time frames to refine my entry. This is a really nice way to ensure, rather increase the likelihood or the probability of a trade turning around at roughly where your entry is. And so I have this 3-chart configuration. Sometimes I even do a 2-chart. I'll just change that to 2-chart like this. And I have my long term. This is my major flows, which I like to look at the weekly or the monthly, or weekly, and I have my monthly levels on there, like you can see. And you can see here on this time frame where the American dollar, Japanese yen is really moving quickly lower. And also notice that we have a high here, a higher high, and here we have a lower high. And so it looks like the price reacted nicely off this monthly supply, and now we're moving lower. What does that tell us? Well, that tells us that when we're on the smaller time frame, whatever that may be, well, you don't want to be buying, because you'll be on the opposing side of the smart money, which is short for the time being, until we get down to this little piece here, or the beginning of the buy zone, which is down here towards these lows, this weekly area of demand. So you have to be really careful about that. Okay, so it doesn't take long. It doesn't have to take long, but you have to know what's going on. You could also be on the one time frame. Okay, so if you're trading on the, let's say, the 1 minute or the 5 minute, and you can see, okay, what's going on? It's moving higher. Just click up to the daily. Where are we? There's no real supply here, and so it looks good to move to look to buy. We're also reacting on this. We have a low, we have a higher low, price left. This is nice. We actually spoke about this trade earlier on around this little small continuation pattern. You may or may not have been stopped out on that. But you can see that we have a low, we have a high low, and we have this really strong push. So we actually have market structure. Okay, the software has done it for us. It is kind of pushing higher. So we have a high, a lower high, a high, a higher low, and price popped through it. So the area of demand that caused this to happen is just down here. Okay, and so now you know that you can trade with more confidence to the upside than to the downside, and that is based on what we can see on the daily and the 4 hour. And so now you go down to your small time frames, and how long did that take? Maybe 30 seconds. So it doesn't take long. You go down to the 50-minute chart, and you have to look for an origin of a strong move. Okay, and so we have this. We have this one, which looks nice. Something like that. We have, it's a lot of kind of levels, testing levels, as you can see, price coming back. So this is very, it looks pretty efficient how we have these, we have prices returning back to this level. This one is still untested, but this one has been tested. This one is still untested. And so price can come down until this rebalancing has taken place. So you have to find the first place where this rebalancing has not taken place. And you can see, actually, if you look here, it will bring us down towards these lows here. This is maybe still longer term. I know we have a couple guys in the room who like to focus on the exceedingly small time frames. There's a gentleman I met at the Green School, another father named Philip, and Philip is trading the Hong Kong index, the HK50 on the 1 minute and the 50-minute chart, and doing very, very well. I think in the past 3 weeks he's done about 14%, focusing on the 1 minute and the 50-minute chart. So his configuration is very quick. So he's on the 1 minute chart looking and making decisions based on this information. And so you can also do that, because you can see here that we're starting to form a downtrend on the 5 minute chart. Does that mean that we're going to go down forever? No, it doesn't, but it does mean that we're in the process of having a bit of a pullback. You can see we had a price kind of left here. We had a period of consolidation here. Our price wriggled sideways for a little while, then it popped up. We have another one, little tiny one here. I better zoom in like that so we can get rid of that. You can see that here we have a 1 minute area just here. Price comes down. This is a low. It comes up. There was no real release. But the software marked this off, telling us that there's likely, there's a likelihood that price is going to react to this level. And you'll notice that price will react at almost all of these levels. And we have this one here, which is testing this one. So we mark off the highs. Price came to that roughly. We have this one. Price came to that roughly. We had this one here, which is this one here. Price came to that. Had this one here. Price came to that. This one here. Price is currently reacting at it. So you'll notice how incredible these levels are. And Philip is looking at the software, and he's paying attention to the beginning of the buys and the sell zones, where before he was maybe subjectively buying and selling when price was a little bit too high or a little bit too low. So the software is going to really help bring this stuff to your attention. But you need to know what's going on in these major flows, okay? Price is moving higher. This is good for us if we want to buy. We don't have supply until around here, which is pretty far away. Okay, and then you slowly wriggle down and you mark off these areas that we can expect price to react at. And I'm finding that, okay, if you have a move like this, price comes down, it goes up, it goes sideways, it goes down. This stuff is lower probability. I'm finding that price is coming down to these. This morning I was going through my losses to analyze it, and I was finding that the reason that I was losing on most of these trades was because I was trying to take these ones here, and that's kind of fiddling in the middle, which is not necessarily a bad idea, but it just depends on the area. And so price can form this very nice rally, accumulation, then rally, and price will easily come down, bounce, and then continue going higher. But often it's looking for that major base where price goes up, sideways up, and then it comes to the beginning of the sell zone, which is typically where these wicks are here. It's going to go a little bit deeper, closer to this base, and this is where it's going to attract the buyers and drive price higher. Why? Well, because people trading here have their stops located here. So it knows that if I have a big order and I'm looking to buy, I need to find the liquidity for my order. And I want to ensure that I drive price to a level where stops are going to be hit, which will release liquidity into the market, which will enable me in turn to buy it up and drive price higher. Okay, and so that's why you'll experience this. And we had a trade on the the Kiwi, and I was looking at this here. This is a 4-hour area. We're looking at this, and look what happened. See, price came down, poked through it, it went higher, had another push, we had divergence here. Okay, draw it properly here. We had divergence here, oscillator going up like that, and then this is where we found it. Why? Because we have stops here. The banks know this. They know that they have a big order. They need to find liquidity to drive price higher, and so it requires that price goes a little bit lower, and then we pop up. Okay, we passed this high, so now the flows are starting to move along the Kiwi American dollar um, uh, for the shorter term. Okay, and so this is what we're seeing play out currently. It's really interesting, really, really interesting. Well, if you're into that kind of thing. So essentially what we need to do is we need to understand what's going on the smaller time frames. And I have this like a mini course. I'm just going to pause the video. I'm going to find this mini course. Give me 2 seconds. Okay. Actually, after I press the pause button, I realize it won't feel like a minute because I'm pausing. Nonetheless, here it is. I'll post this link in the forum. But this is simply just a rundown of how you can do your analysis and some of the things that are important when you're trading. And then it focuses on, I mean, all different trading styles. It also talks about the different time frames that you can consider. I think in this one, it tells you if you're longer term or shorter term. But it's very interesting, and so you should certainly watch this and see if it's helps at all or is interesting. But so, I mean, the model is exactly the same to a position swing trading. You look at the big time frame, you see who's buying and who's selling, and then you go down to the smaller time frame with this information in your mind, and then you trade in that direction. So if price is doing something like, let's have a look. Okay, so if price, when this is formed here, if price comes up here and its price is down here and you're looking to buy here, is that a good trade? No, it isn't. Is this level that was marked off here going to hold? No, it's not. Why? Because we're just reacting to weekly supply. We can't possibly expect price to continue to move higher when we see weekly supply being formed above price. So really bad idea. Let's have a look here. So okay, when we had this area here. This is the dotted one. It was tested here. Are you going to try and sell here? Absolutely not. Why? Because we just reacted to weekly demand. So you really have to be careful. And if you don't know this information, if you don't know the price is sitting on a weekly supply or demand or whatever, then you're going to be trading in the dark. And this is why multiple time frame analysis is so important, because it's going to bring this kind of information to your attention. Let's have a look at another one. I mean, here we had this area here. Price has tested it many times. I mean, is it a good idea to start selling? No, it's not, because we have higher lows at weekly nested monthly demand. And so this is a really bad place to start to sell. Okay, we have this trend line here. When this breaks and we have market structure failure, then maybe, but you have to be careful about this kind of thing. Let's see if we can see something else on here. Yeah, we had this area here. Price marked this off, and then it left, kind of moved to the edge of this area of weekly supply. Now it's moving away. Is this a good time to buy, like down in here? Absolutely not. And you can see here, rightly so, after reacting to weekly supply, the price started to gap lower. Really bad idea to start to sell. And this one here is interesting because price left here, and we have not been back to that area. Okay, we've been back as far as this. So when price comes back to here, what do? You go down to the tiny time frames, the 1 minute, 5 minute, 15 minute, half an hour, and then you look for entries in this area here. You'll see very clearly on the smaller time frames, price poking in and then being rejected, and then having a deeper push and being rejected. And this is what a head and shoulders pattern, if you're into that kind of thing, is. It's kind of an attempt to kind of seek liquidity to find. This is when price goes down, it's advertising a low price. Or advertising, a lot of people bought it. Okay, we'll have another advertise, and okay, keep in mind, once it moves above this high, a lot of traders are thinking, oh shit, I didn't get in I got to get in if price comes down to these lows. But again, I'm going to totally jump in. And so price comes down. It comes down to here. It goes up. People aren't convinced yet. Price pushes lower. It's just this is really good value. Then price pops up. And when it moves above this high, people think, okay, people have discovered that it's value, so they're starting to buy. And so when it comes back again, they kind of look at roughly the same area, and then they start to buy. So this is essentially what is happening when you see a head and shoulders pattern. I don't look at patterns, I don't see them. But what I do see is currency strength divergence on the histogram and just these pushes lower into demand and pushes higher into supply. Okay, so wait for price to move into, let's say, even 4-hour supply and demand, and then trade the rejections on the smaller time frame. So if we go to the 4-hour, if we just look at this one just here, okay, see the robot's telling us to sell here, this little rectangle. But let's focus on the one just above. Let's focus on this one. You go to the 5-minute chart. Let's get some data. Scroll over and see, okay, what do we have here? Well, this is our area. Get rid of these lines. Okay, price left. Really nice push away. Boom. So this is nice. So when price comes back to this, you can expect it to continue low, but you don't really know when it's going to happen. So what you do have is you have to look for what we experienced in our drawing, my hand drawing before, where we have kind of a shoulder, a high, and a shoulder. And this is a sign that things are turning around. So we've got high highs and the price and the histogram is doing this. And then when we get this lower low, well, then it's just time to get in. Okay, and you can see this. We have the, what do you call it? The collar line, or whatever you want to call it, or the neckline, sorry. And once price pops through there, or just get in, and you can see here very clearly. I mean, we're supply and demand traders, so you can see. I'm going to continue using these. I like these. We have this area of demand here, and it was tested once, twice, 3 times, 4 times. When price comes down and through that, well, then you want to sell it when price comes onto it the next time, because price will almost always react to these on the opposing side. So support becomes resistance, and this is kind of like a flip zone, and price moves away. And so it's important that you mark off the area of supply or demand that is nested within the greater period supply or demand, and you look for the area of supply that caused the consumption of the opposing supply and demand. And so that would be this one here. The price didn't get that far, but what it did get to is this area here, which was the area of demand that price managed to cut through. And so sometimes this area of supply will be located on top of this area of demand, and price will normally poke up into it, but sometimes it won't. And if it isn't, okay, yes, so I mean, this is essentially what we need to look for. And why is this important to us? And that's because it is happening within supply. Okay, so we have the probability of price turning around is higher than had we done it just in the middle of any old space. Here, price is moving into supply. We can expect price to turn around and move down like this. And we're getting this very nicely here. Okay, so if you're into patterns, got the left shoulder, the head, right shoulder. You have the neckline there, which is broken. And this is the area of demand that was consumed. Supply that did it is here. So look to sell in this area here. Good. Well, I think I'll wrap it up for now. A lot going on here. We're currently holidaying in North Valley, and it's absolutely beautiful. And there was a plate that just broke in the kitchen and some other stuff, so I'm going to go and attend to that. But if you have any questions, please send them in the room, and I'll get to them as soon as I can. Thanks for watching.